Well, it's very interesting to see that the market barely moved, in fact, tracked downwards slightly. And that's because although there were quite a lot of policies, in fact, more than we would normally see in an autumn statement. Normally it's the spring budget where you see a great number of policies, but this is very indicative of the fact that this is a Conservative government trying to stay in power, and so bringing in policies earlier than they might do in the normal sort of political calendar in order to make that impact as they go into an election year. So there were quite a lot of policies that will impact the consumer and small businesses, but these aren't the sort of policies that will impact the market. And the market very much only heard the news about the growth forecasts and inflation, and that is that growth forecasts for 2024 have almost halved, and for 2025 have come down as well. Now, this isn't a recession. The OBR, the Office of Budget Responsibility, that does these figures suggests that we're not going into recession in the UK next year. It's worth pointing out that other people think we will. So a number of large economists think that we will. Those from Schroders, those of the likes of kind of Morgan Stanley. UBS, in fact, is very bearish next year for developed markets. But the OBR says we're not going to recession, but much lower growth, and that inflation continues to be sticky. So the inflation target of 2% set by the Bank of England is still not going to be hit until the second half of 2025. And that's the piece of news that the market very much heard, rather than the policies around supporting smaller businesses, supporting pensioners, supporting savers and investors with some changes to the tax wrappers, which will allow them to save more money and invest more money in a tax efficient way. Very much for the markets, it's all about growth and inflation, or lack thereof.
Emma, real concern here that some of what's been announced in the statement is actually quite inflationary as well. What does that mean for the Bank of England, particularly given this new target around 2% 2025 on the inflation trajectory?
Yeah, it's a really interesting point, because the Chancellor, when he first stood up, did point out that although there was a lot of positive news in terms of growth returning to the UK and inflation coming down, albeit not as fast as it's coming down in the US and in Europe, that actually he was very much walking a tightrope himself. He did use that phrase. And you're right, some of these measures, although they are suggesting that they will be economically boosting, they are potentially boosting inflation as well. So two main ones which could be inflationary are the 8.5% increase of the state pension in the UK. That's basically a pay rise for a huge swathe of consumers, which means they'll have more money in their pocket, which means that they'll go out and buy more. And of course, that supply-demand equilibrium is what drives inflation. And the other one is the basic wage increase as well. And this is also going to have a big impact on smaller businesses. There are a number of policies to support smaller businesses, but smaller business owners have come out today and say, yes, but that is countered with the fact that, you know, last year our input costs were going up in the terms of kind of supply chain and inflation for materials. And now one of our costs that will be going up will be employees, will be staff costs, because there's an increase in the basic wage. Now, it's absolutely understandable as to why the government have taken these measures. The cost of living has been going up, and so they're therefore supporting those that are most vulnerable in society, i.e. pensioners and those on lower wages. But putting that into the system potentially has the impact to drive inflation. And as you know, in the UK, we have a persistent inflation problem. Our inflation has not come down as far as it has in the US and in Europe, so it's something to very carefully watch.